Hi, I'm Tim Chubb, Chief Investment Officer here at Girard. One of the most common questions we're getting nowadays is, with cash and money markets or CDs yielding 5%, why bother owning anything else? We think it's a great question and it merits a balanced answer. Maintaining a source of funds that can be accessed quickly is critical, but cash is not what you should be looking for in a long-term investment portfolio. And for most investors, most of their wealth will be spent far in the future. Given the risk taking with stocks and longer-term bonds, these investments generate a premium to return in compensation for the risk. This is a foundation of a resilient, diversified portfolio, and we really look forward to bringing this idea to life in today's video. Following the global financial crisis, we had a multi-year period where interest rates were so low and cash returned next to nothing, and now we're in an environment where cash-like vehicles, including money market funds, short-term CDs, and treasury bills, have yields in the mid-single digits. Money market fund assets have swelled to over $6 trillion as investors have sought an alternative to risk-based market returns, but we want to caution over using cash as an investment vehicle. A 3 or 6 month T-bill will not return 5%, it'll be 1.25% over 3 months and 2.5% over 6, at which point you'll have to hope for sustained higher interest rates. This example of reinvestment risk shows how a 5% starting rate could ultimately result in a 4.7% rate instead if the Fed were to follow the expected path of interest rates. We think it could go even lower if the Fed has to respond to a Fed-induced macroeconomic slowdown. And at the end of the day, you cannot just T-bill and chill forever. This kind of trade works until it doesn't. And it's essential to distinguish cash as held for liquidity, emergency, and upcoming expenses from the small amount of cash that should be held in a long-term investment portfolio. And to bring that point to life, let me turn it over to Chris Briscoe, Girard's Wealth Planning Director.
Thanks, Tim. The appropriate level of cash depends on one's financial situation and goals. It's an important decision to make early in the planning process and should encompass a long-term view. So what are some good reasons to hold cash? Emergency funds. Funds that are meant to replace income if one loses a job or suffers an unexpected expense. Medical bills, car repairs, emergency home repairs. If you're working, we generally recommend 3 to 6 months worth of expenses as a good starting point. If you're retired, that amount may need to be a little longer, like 6 to 12 months. In addition, you might be planning for a larger purchase in the future, buying a home, taking that vacation you've always wanted to go on. Funds for these purchases should also be conservative, and cash is a good place to be. What are some not so good reasons to hold cash? Timing the market. Why? Timing the market's practically impossible to do. Remember, you have to be right twice. When to get out, but also when to get back in. If you're expecting cash to outperform, this may work in the short term, but long term, cash is not necessarily king. It's important to remember, be cognizant of reinvestment risk. In other words, what will rates be when my treasury or CDs mature? If you have a larger than normal cash balance, here are some things to consider. Dollar cost averaging. Invest a fixed amount of cash periodically, regardless of where the market is. You'll buy at different prices along the way, and this will ultimately smooth out your average cost. Eliminate high interest debt. If the interest rate on your debt is higher than the interest rate you're currently receiving on your cash, you might want to consider paying off more debt. It'll save you money in the long run. Stress test. Build your financial plan, run some different scenarios to determine if your level of cash is appropriate or if you might need to put more cash to work in order for your plan to be more successful. Budget. Build a budget to pinpoint how much you should be spending on needs, wants, and how much you should be saving. And finally, larger emergency fund. It just might be that your risk tolerance and current financial position points you to holding a larger than average emergency surplus beyond that 6 months of expenses, and that's okay. Let's just keep that separate from how we view the longer term portfolio.
Thanks, Chris. Many think of holding cash as riskless, but investors are actually making an implicit bet. In this case, holding on to significant excess cash is a bet on stagflation, rates staying higher, but the economy not quite going into a recession. We think this is unlikely, and even as an investor gets the idea right, their ability to get in and out of cash is highly challenging. The reality is that cash is not a long-term savings vehicle, and the likelihood of an individual investor being able to time the market effectively, of knowing when to get out of the way in the downturns, is low, not to mention the stock and bond investing historically has weathered downturns with substantial recoveries. While bonds and stocks are down 1.5 or 2 times each decade, it's difficult to determine which years those will be, and what the likelihood of the average investor is to pick this year's stocks or bonds being down. When the Fed stops cutting rates, longer-term bonds tend to outperform. The Fed is responding to normalized inflation and often much slower growth or even a recession in the horizon. In this environment, investors demand lower returns in the future. Given growth outlook, yields drop, making bond prices go up over the 12 months after the end of the rate cycle. While money market funds still have a nice positive return, this chart doesn't necessarily reflect the fact that those rates start the period high and they fall as the subsequent year progresses. An investor is left with a lower starting rate the following year, and the same is true for CDs, which, according to Vanguard and Bankrate, see an average 5% peak one-year yield, which declines subsequently in years historically. Having easily accessible funds is just as important as stocks and bonds when the name of the game is growing your long-term wealth. Having investments with cash, money markets, and CDs will meet the immediate needs, and bonds and stocks satisfying the longer-term needs. With the recent bump in interest rates, it might be tempting to move your attention away from risk-based market returns to the instant gratification of cash-like channels, but ultimately, with the help of your trusted advisor, you need to evaluate your current financial situation and risk tolerance, keeping your cash separate from your investment portfolio. We like to say that we approve for cash for now, but we'd like to see you settle down with bonds, especially if a long-term investment approach is what you're after.